Good afternoon to our friends here on the East Coast. Good morning to those in attendance from Central, Mountain, and West. Thanks for joining us at 12 o'clock here on the East Coast. This is by far our highest attended event since the beginning of COVID. So we are excited to share with you a program that we think will be very useful, particularly in the current environment. In growing your life insurance practice during extraordinary times. I have a special guest with me today. I'm rather than handling the majority of the content today, my role as a moderator, we really brought in a subject matter expert that if you haven't heard of or read his commentary or seen his YouTube channel, you'll be certain to tune in going forward. He is the foremost expert in this subject matter. So the theme is embracing the opportunity. With change comes opportunity, and there is still estate planning to be done. There's still life insurance to be written, and even though the virus is still here, the planning opportunities don't stop. So it's time to just adjust, embrace the current environment, and write a whole bunch of premium as we approach the fourth quarter, into the fourth quarter and the close of the year. So again, I'll be moderating today. Our special guest is a gentleman named Linus Sudis. I thought I had his bio on the screen, but if you don't see him, Linus is a consultant. He is the author to Think About It, which was a publication founded by industry guru Steve Leinberg. He's a regular speaker on the circuit of AALU Forum 400. Today, he was kind enough to affiliate with us through our partnership with North American Life Insurance Company. He is a paid, retained consultant for highly complex advanced planning matters. And in doing business with North American, you get access to Linus, which is an invaluable resource. So, COVID-19, health challenges, and accompanying anxieties have really swept our country. And regardless of what's going on in our personal lives, our financial lives are in flux, yet our estate planning matters remain stagnant. And as we engage new clients and re-engage old friends, there's a lot to talk about. So that's the goal of today's agenda, to give you concepts, speaking points, and opportunities to activate a relationship that's either gone dormant or that you are courting as new, or to rekindle old relationships. So I think you'll find we have about an hour. This webinar will be recorded. Whether you attended or if anyone had missed and registered, they'll get a copy as well. As an additional follow-up, Life Brokerage specializes in one-page illustrative designs that are client-friendly. We will circulate to you 6 illustrations, one-pagers that will be in the Life Brokerage brand. Just know that we can customize them into your brand, and that depict the story that Linus is about to tell on each of these subject matters and how you can explain them to a client in a clear, concise fashion in a couple minutes or less. So without further ado, I'm going to introduce Linus. The first topic today is Beneficiary Designation Review. I can tell you that firsthand, this is the single most important revenue generator at Life Brokerage. If it's reviewing policies, performance, taxation, structure, beneficiary, more often than not, clients are unaware of who the beneficiary is, who the contingent beneficiary is. So, Linus, I'll tee this up for you. Give us some ideas on how to activate a relationship, what you see in the field, and you've made a comment to me that most of the beneficiary designations you review are actually wrong. So give us some color around this subject.
Sure. Thanks, Anthony. And thanks for letting me be part of your presentation today. I agree. Beneficiary designation review is perhaps one of the most overlooked things that life insurance and financial professionals don't pay enough attention to. As you said, in my experience as a lawyer who has had his own estate planning practice, I've seen beneficiary designations be wrong. And in fact, I would go so far as to say, in my experience, more than half of beneficiary designations that I saw were flawed in some way. We'll get into how they're flawed in a second. But when I worked with clients in my estate planning practice on their estate planning documents, we typically spend, say, about 4 hours on their estate planning documents. Let me ask those on the call this question. How much time when you're filling out a life insurance application or an annuity application or the beneficiary designation on an IRA, how much time do you spend with your client on those issues? How much time do you think the average agent spends with the client on those issues? I'm pretty sure it's not 4 hours. And from my perspective, that is the beginning of the value of a beneficiary review. The first question that I sometimes get asked is what's the biggest mistake clients make on their beneficiary designations? And I think the biggest mistake is when the estate of the client is named either the primary or the contingent beneficiary. And a lot of times it's the estate as contingent beneficiary because that's the default that's imposed by either the financial company or by the life insurance company if no specific person is named. What's wrong with the client's estate being the beneficiary of, say, a life insurance policy? Well, there are several things, and we'll talk about a court case in a minute, but they are all centered around the idea of forcing life insurance proceeds through the probate process. If we've got a named beneficiary on a life product or other financial product, by operation of law, that money gets directed to the beneficiary and it bypasses the probate process. If the estate is the beneficiary, then the probate process gets involved. What's wrong with probate? Well, probate usually requires a lawyer. It is a public proceeding. It takes time. Creditors usually get a crack at the money. The decedent's creditors usually get a crack at the money that's going through the probate process. And the process takes about a year from start to finish if everything goes reasonably well. And so you can see right off the value of having a named beneficiary as opposed to letting the client's estate be the beneficiary and forcing the proceeds through the probate process. It's just, better all the way around. The client's intentions are honored in a much more efficient way. So what else might be a flaw in a beneficiary designation? So the first flaw is, are the beneficiaries consistent with what the client currently has in mind? A lot of times a beneficiary designation might be good when it's done by the client, but then things happen, life happens, things change, and sometimes the clients don't pay attention to the change in circumstances as they think about their existing beneficiary designations, and that's really a lost opportunity. And those beneficiary designations can go stale over time. The most common situation that really leads to problems is divorce, where spouses named the beneficiary at the time the life policy, for example, is taken out. The clients get divorced, and of course, after the divorce, it's likely the client doesn't want ex-spouse to be the beneficiary, but perhaps not enough attention's been paid, the change hasn't been made in a timely way, and something happens to the client, and ex-spouse ends up being in line for the money. That's a problem. And it's one more reason for you to stay in touch with your good existing clients to make sure that you're aware of any changes in their lives, which might indicate that a beneficiary change is appropriate. But as you talk with others, prospects or people with whom you're trying to deepen a relationship. Making sure that the beneficiary designations are still good, that the original intentions are still represented with the beneficiary designation. It's an important thing. The client may have very sophisticated estate planning documents. I understand a lot of you work with sophisticated clients, and may have all kinds of rules about how people get money and what the circumstances are, with trusts and those kinds of things. But you want to make sure the beneficiary designations are consistent with what the estate planning documents say. Those of us who are on the call understand that a beneficiary designation will supersede what the estate planning documents say, but our clients don't necessarily understand that. Our clients may put together all these sophisticated plans, but not quite understand that if they have a person named as a beneficiary, the controls that are in their estate planning documents won't apply to that money. So having that conversation with the client, making sure that there's a good marriage between the beneficiary designation and the estate planning documents is really an important thing.
Dennis, if I may interject, as a wholesaler underwriting thousands of applications during the course of a year, I can tell you that this is the boring part of the process, right? Agents are spending 30 seconds on this, getting the application completed. And the biggest hurdle is, do I keep the client hot to buy? Can I get them through underwriting? Hurry up and let's get this done. And 3 out of every 10 applications we see name either a minor child as either primary or contingent, or the estate of the insured. So just a very simple beneficiary designation review could disrupt the client enough to open up their personal artifacts to you and give you an opportunity to either, again, rekindle an existing relationship or spark a new one. So
it's a great point. Yeah, go ahead, Anthony.
There's a recent court case that kind of slammed this point home. Would you care in sharing some color on this case?
Yeah, I will. Before I get to that, let me make one quick point, and that is that beneficiary designations control probably more liquid wealth, the transfer of more liquid wealth at death than any estate planning document does. And so, it just reinforces how important it is. And, your point that the beneficiary review can really open the door to a lot of relationships. But yeah, we'll move to the court case. This is a situation which underscores the problems when an estate is the beneficiary of a life insurance policy. And so in this court case, we've got Tobin, who bought a life insurance policy, and he named his wife and his daughter. His wife, the primary beneficiary, his daughter, the contingent beneficiary. And in this case, both the primary and the contingent beneficiaries had predeceased the insured. And so the insured's estate ended up being in line for the money because there was no tertiary. How many of us named tertiary beneficiaries? There's no third beneficiary named for the life insurance policy, so the estate ended up being in line for the money. There were claims against the insured as part of the insured's estate. And the executor went to the court and said, hey, under Arizona law, life insurance proceeds are protected against the claims of creditors. And the executor asked the court, hey, let's make sure that these life insurance proceeds are protected, that the insured's heirs end up getting the money and the creditors don't get a crack at it. Let's go on to the next slide, Anthony, if you would. And so the key part of this was that it turned on Arizona law. And I don't want anybody here to be an expert on Arizona law, but the language of Arizona law made it clear that if there was a named beneficiary, the proceeds would have been exempt from the claims of the deceased's creditors. However, where the insured's estate was the beneficiary, the court said Arizona law said that the life insurance death benefit was accessible by the insured's creditors, and therefore the insured's heirs would not get the money, aside from that claim. That claim had to be dealt with before the heirs would get the money. Now, again, I mentioned I don't need to make anybody an expert in Arizona law, but other states have rules in them similar to the rules in Arizona. And so when I say the estate being the beneficiary is a problem, that's one of the issues that I'm talking about, is that the creditors of the insured get a crack at the money, whereas if we have a named beneficiary, they don't. And that's a big deal. Making sure the family gets the money is a big deal. All right, let's shift focus. Before we move on to lifetime gifts, Anthony, was there any other point you wanted to make there?
Just to slam home that more often than not, the single biggest asset to transfer wealth is being sloppily passed around, to be managed by either probate judge, creditors, and be tied up in the courts. I mean, you don't work to fund premiums to have a probate court determine how they are passed along, how they pass along proceeds to your heirs. So again, very simply, just quick review. And while you're along the lines of beneficiary review, now we're presenting the opportunity to run performance in-force ledgers, looking at cap rates, dividend scales. I mean, it kind of all goes with it. Well, the beneficiary designation review is really the door opener. Let's move on, Linus, in the essence of time, talk about lifetime gifts and the misconception that gifts are limited to $15,000 a year. And although clients have accumulated significant wealth and are extremely intelligent, a lot of them are maybe misunderstand the tax law. Tell us what you're seeing in your practice around lifetime gifts.
Yeah, well, we get a lot of calls from producers, and that's our business model, and they are confused about lifetime gifts, and so you can bet that your clients, so at least some of your clients, are also confused about how the lifetime gifts rules work. You alluded to the fact that many people are under the misconception that gifts are limited to $15,000 a year. That's true. You can only make gifts of up to 15 grand a year without doing anything special, right? You can write somebody a check for up to 15 grand and you don't have to do another thing. As long as the aggregate amount of gift that you're making to somebody else is 15 grand or less, you're done. That's the extent of it. And some people who are a little more sophisticated have heard that the gift tax rate's 40%. What they don't necessarily know is that bigger gifts are possible, that in addition to the $15,000 per year annual exclusion, there's also, this lifetime exemption that coordinates with the estate tax exemption. That's currently the federal estate tax exemption and combined federal and gift tax exemption, estate and gift tax exemption is nearly $11.6 million. And so it's possible for somebody to use up that exemption amount either during lifetime or choose to use some or all of it after death. And the only consequence of using it while you're alive to make a gift is that a gift tax return has to be filed. And the gift tax return looks a little bit like an income tax return. The gift tax is a separate tax from income tax, but the gift tax return really isn't that complicated. It's pretty much a one-page form. And on that form, you tell the IRS how much of a gift you made and how much of your lifetime exemption you're using up with respect to that gift. And so it isn't that hard. And that's a surprise to a lot of people. It's also a surprise to a lot of people that if someone's making $15,000 per year gifts, it doesn't reduce that roughly $11.6 million federal lifetime exemption either. You can do both and maximize both if you're wealthy. For those of you who are on the call that work with sophisticated clients, this is no surprise to you, but sometimes our clients don't realize this. And so explaining that can be an opportunity as we're working with them. So what kinds of special issues and opportunities might arise in connection with sophisticated giving? couple of things. It might be harder to fill out the gift tax return if we've got hard to value property. For example, if the client has a substantial interest in a closely held business, well, we know that businesses are hard to value for gift tax purposes. The IRS wants people to put down a value on the gift tax return that is equal to the fair market value of the gift. Well, what's a minority interest in a closely held business worth? That's a hard thing to figure out. And so sometimes if our client is trying to make gifts of that type, then employing the services of an expert in valuation may be part of the process, so that the client is prepared to defend with the IRS the value of the gift. Now, why might a client want to give away a minority interest in a closely held business? Well, if the business is going great guns, the client has all the wealth the client needs and is trying to transfer a business or other hard to value property to the next generation, so the appreciation ends up in their hands. You know, it's a logical strategy for somebody to follow if they're willing to part ways with property. So you might run into that. When we implement irrevocable life insurance trusts, and we do that in a lot of cases where clients have estate tax problems, while life insurance that's personally owned is income tax free, the death benefit is included in the client's estate for estate tax purposes. One proven way that we can get the death benefit out of the estate for estate tax purposes is to have the coverage owned by and the beneficiary be an irrevocable life insurance trust. We often get asked, well, how does the trust get money to pay for the life insurance? Well, it's usually because the insured makes gifts to the trust. And there are some nuances there in trust administration and trust formation for people to manage that. You may have heard the term crummy powers. That's a little trick that the IRS has approved, where we give the beneficiaries of the trust a little window of time to get a gift out within 30 days. And if we do that the right way, the gifts have the potential to qualify for the $15,000 annual exclusion. But there are other ways to deal with issues in irrevocable life insurance trusts. It is possible for very wealthy people to make sophisticated gifts. One way that has been popular probably over the last few decades is family limited partnerships. A lot of times people will put family limited partnerships around their wealth. They'll put that wrapper around their wealth. They'll make themselves the general partners, and they'll give away limited partnership interests to family members. And the IRS in the past has been forced to concede that those limited partnership interests that are given to family members, the value for gift tax purposes is discounted because the limited partners don't have a lot of control. There's been a lot of litigation over family limited partnerships and those types of techniques. FLPs have fallen a little bit out of favor, but they're still a valid estate planning technique, and you should be aware of them and understand that the gift tax valuation can be hard. It's also possible to make gifts through things like grantor retained annuity trusts. Although in this low interest rate environment, grantor retaining any kind of ownership interest in through a GRAT has become less attractive. We'll talk about some other techniques in a minute that are more attractive in a low interest rate environment, but GRATs tend to be less attractive. And of course, why gifts? We're managing estate taxes for a lot of people. We're managing the growth. And we're also potentially on income producing property that we give away, we're possibly income shifting. Anthony?
Yeah, just to piggyback off that, putting my insurance hat on, once you complete the gift, the question is, what does the recipient do with the gift? And, we have been modeling specific policies to create somewhere between 7 and 11% non-correlated IRRs at life expectancy. And if you lever up the estate tax equivalent versus not gifting, it makes a world of difference, right, to the next generation. Software models that we're also utilizing is comparing against alternative investments. So once the recipient, whether it be a child or a trust or a grandchild, takes receipt of that gift, then again, how do you deploy it and what do you compare it against? And I'll add lastly that most clients have this perception that gifting involves cash. And as Linus described in detail, open your mind to gifting other assets, business assets, income-producing real estate, highly appreciable stock. These things can also generate deal flow that create a premium and that you can then labor up through death benefit as well. So great topic. And we're going to get into some of the meatier discussion around today's planning opportunities. And this is one of my favorite, Linus, split dollar. And when I think of split dollar, I really think of three things, three aspects, and how we're using them in our practice. All can be illustrated on a one-page concept. First and foremost, I think of executive comp, and I think of the celebrity NCAA coaches and the abundance of split dollar plans that have been written with their employers who are nonprofit universities. That's one type of split dollar. The second type of split dollar we see quite frequently is corporate. With the corporate tax rate being slashed to 21%, we find it more efficient to lend dollars to a trust rather than distribute at ordinary income rate. So the great, wonderful arbitrage, particularly for C Corps in corporate split dollar. And lastly, in our opinion, the type of split dollar strategy that provides the most flexibility to any one particular grantor is private split dollar. The ability to lend assets to a trust, structuring with high cash value life insurance, provides ultimate liquidity, flexibility, control, can call the note, can repay the note. You're not left in a position to run out of money or make this irrevocable type transfer of wealth. It is most certainly callable. So, Linus, can you expand on split dollar, why the recent popularity, and just some clarification around the rules and regulations?
Yeah, Anthony, that was nicely summarized. I mean, from my perspective, you're exactly right. There are still opportunities with split dollar. The rules changed, it's hard for me to believe, almost 20 years ago. It used to be that we used split dollar primarily as an owner compensation technique. The regulations in 2001 effectively killed what we called equity split dollar, changed the rules. And now there are a couple of ways that the IRS says that you have to administer split dollar, but we'll talk primarily about loan regime split dollar today, where the advances by either the business, as you alluded to in compensation split dollar, or by the family member are treated as loans to the participant. There's some tremendous opportunities there. To me, the best example that you alluded to in terms of compensation for a key coach, right, is the Harbaugh story. Jim Harbaugh on the University of Michigan negotiated a split dollar deal as part of his compensation package. It's a loan-based split dollar deal. And so what's happening is essentially the university or an organization indirectly under its control is loaning money to Harbaugh to buy permanent life insurance. And the expectation is that the policies, it's a permanent policy, the expectation is the policy's cash value growth will outpace the loan interest. And the increase in equity is going to accrue to Harbaugh's benefit. And so it ends up being, in effect, for Harbaugh, a deferred comp kind of deal where he gets a fair amount of control over when he decides to take the income and how he decides to take the income. The income can be income tax free. Now, like premium financing, there is some risk in this that the policy will not perform or will not outperform what the university is putting up in terms of a premium plus loan interest, right? There's some risk of that, but there isn't really much risk under the split dollar rules. Harbaugh doesn't have to pay back more than what the policy's worth, and so he enjoys the potential for the upside without really having any of the downside that might be associated with a more third-party financing arrangement. And so there's a significant opportunity for arbitrage there, and that's something that can be presented to the very key employees, not only in sports organizations but in all organizations. Let's go ahead.
Dennis,
and go ahead.
Yeah, well said, and that's a huge advantage to the key person. Talk about the new law with executive comp and executives of nonprofits earning greater than $1 million and potential excise tax to the nonprofit, and the incentive for the nonprofit to enter into a split dollar agreement with their key person.
Yeah, the law limits compensation to $1 million in the case you described, Anthony. And if the organization pays more than $1 million in comp, there is an excise tax. And so the value of benefits that are not directly considered to be comp, right, increases in value. And so something like this, for any coach, a guy like Harbaugh, where there's only potential upside and no real downside, and the potential for upside between the interest rate of the split dollar plan and what the life insurance policy accrues can be huge. In this interest rate environment, the IRS imposed interest rate on a loan is less than 1%. And that's significantly less than the guaranteed interest rate on a lot of life insurance policies.
Yeah, today it's 40 basis points.
So
the details around this particular case saved the University of Michigan approximately $400,000 per year for tax years 2018, 19, 20, 21, 22, 23, 24. $400,000 per year over a 6-year period.
So yeah, so making this part of the comp package ends up solving a lot of problems, including the possibility that if somebody bolts early from employment, that the employer gets their money back. So again, with coaches and other key people, that risk is real, and so it's a good way to hedge. Let's shift. Let's talk about. Go ahead, Anthony.
Just one closing comment there that I think the callers would appreciate. You know, this isn't just for highly paid coaches, right? We're seeing directors in hospitals. We're seeing surgeons. We're seeing key employees of nonprofits earning well in excess of $1 million. And in order to keep them at the University of Pennsylvania so they don't flee to Mayo Clinic or another institution, these plans are being administered quite often. So don't dismiss looking at that demographic if it hits your network.
Yeah, I suppose the only downside of a split dollar plan is that it requires a trip to a lawyer. A lot of people don't like that. I don't know why. We're fabulous people, but there you go. So let's talk about family split dollar. There are a lot of ways that family split dollar can be used to help finance certain circumstances. One way is between somebody who's got an estate tax problem and an irrevocable trust. The person with the estate tax problem can lend money to the irrevocable trust under a split dollar plan, and under loan-based split dollar gets back a small return on the premium, whereas the death benefit ends up being much bigger than the loan amount. And it's an effective way to manage the gift tax consequences that might otherwise be implicated in an estate tax management situation. So if you've got somebody worth, 20, 30, $50 million of wealth or more, family split dollar makes some sense to think about to help control the gift tax cost of providing the life insurance in an irrevocable trust. In addition to that kind of generic and simpler approach, it's also possible for multi-generational split dollar to work out. The Morissette case is really the poster child for that, where a mom helped her two sons finance needed life insurance to fund a business buyout. Mom provided the money. Mom kept a security interest against the policy equal to her premium advances plus interest, so it's loan-based split dollar. And the sons had access to the remaining cash value and death benefit. Ended up being an efficient way to provide the financing. The reason we know about the case is that at mom's death, folks were trying to value mom's right to get the death benefit back, or the mom's right to get her loan balance back. And there was an argument over whether that was entitled to discounting or not. They never did quite resolve that, but in any event, that's the reason why we know about the case. And we know that in a multi-generational situation, loan-based split dollar can also be a tool to help provide money for needed life insurance. I mentioned the ILIT funding. Anthony mentioned split dollar is a key employee benefit. I mentioned earlier that you got to hire a lawyer to do it, and administration's a little bit of a bother. It's not a super big bother if you're talking about premium amounts. I mean, at the end of the day, it's probably worth it where it's a fit. But you're not talking about $500 a year premium cases here, where split dollar is going to be a fit. You're generally talking about 5 figures or more in annual premium to make it worthwhile going through the hassle.
Lynn, it's shifting gears. We're right on time here, and that's a great segue because we're leaving the split dollar discussion because of low interest rates, and we're entering into a wider scope of low interest rate planning opportunities. This is one of my favorites, quite honestly, and again applicable for life insurance. So put your life insurance hat on while you're learning, and think about purchasing on Gen A or Gen B. As Linus discusses, low interest opportunities using AFR arbitrage and mirror loans.
So the IRS publishes loan interest rates on a monthly basis, and the rate as Anthony alluded to earlier is less than 0.5% currently. Can you think of circumstances where your clients who have a fair amount of cash might be willing to lend money to other family members, and can you help those other family members earn more than half a percent of interest in some kind of product? And if the answer is yes, if mom's got an estate tax problem and is willing to do that, it feels like a no-brainer to run down that path, doesn't it? You can get the appreciation, future appreciation on the underlying capital asset in the hands mostly of the next generation or the generation after that, as opposed to the generation that's worried about estate taxes happening sooner. It's worth considering. You don't need life insurance to pull that off. And while you certainly can make life insurance part of the overall architecture of what it is that you're proposing, lending money at the current interest rate so that the younger generation is able to take advantage of the arbitrage makes perfect sense for people to consider.
So Linus, let me get this. Let me just recap this. So yep. you have Generation A, and I wish this was the case, but unfortunately it's not. Mom is ultra wealthy. She's sitting in fixed income. She's maybe grabbing 25, 30 bips on her assets in cash. Gen B is struggling a bit. They're modestly wealthy, probably overspending. Family of 5. They have the 2.2 kids and the extra large SUV, and they overbought in a 3-acre estate in Homedale, New Jersey. So mom can lend her son a couple $1,000,000 so that he can go out and become an entrepreneur.
It's the president's model. Yeah, I mean,
Right.
it's a little bit of a snarky answer, but the answer is yes. Why not? I mean, if mom's got the money and these are the rules and we're playing within the rules, why wouldn't we?
And utilizing the North American smart money concept, where you have a guarantee cash surrender value equal to premiums paid with an upside of say 8% on a cap. I mean, that product alone can, on a guarantee chassis, can outpace the AFR rate with potential to generate it 8.5% caps. Right? If you're looking at comparing alternatives to Generation B, investing mom's money that they're borrowing at 40 basis points. I just can't resist.
Yeah,
you're resist these product recommendations, Lennon. I just can't resist.
Well, no, I mean, but that's exactly right. I mean, at the end of the day, all of this works if folks sell product and the product makes sense for the client. And I think you just made a great case for it. One more thing before we get off of that topic, don't limit your thinking to family situations. If you've got somebody who owns, say, a C corporation and is trying to figure out how to get money out of the C corporation into her or his own hands, using loans from the business to themselves is, at least right now, seems to be an efficient way to be able to use that money without paying taxes today. Now, there is a day of tax reckoning eventually there, but that's an idea for the future. A lot of times, a client's CPA will be completely on board with the idea of putting off the day of tax reckoning if the client wants or needs the money out of the business into the client's own hands. All right, let's go ahead. Go ahead.
Yeah, as we move into charitable giving, this is idea number 5. This is a layup. I mean, this is a gimme. So this may not directly generate life insurance or annuity revenue, but wow, when I learned of this strategy, I learned that there is no reason to approach any individual that I know or agents who have a network of clients who own qualified assets. So why don't you dig in here a bit?
Sure. So, in a low interest rate environment, what we normally would be inclined to talk about, if the interest rate environment were different, would be charitable remainder trusts. And we usually talk about, being able to avoid capital gains tax, and being able to get a charitable deduction in the first year, and use charitable remainder trusts. And they work pretty well if the interest rate environment, in terms of the IRS table of the month, is higher. Charitable remainder trusts look better when those interest rates are higher. Well, we're in a really, really low interest rate environment today. So what does that mean? It means that flipping the trust and creating a charitable lead trust can look more attractive in a low interest rate environment. Well, what's a charitable lead trust? Well, a client makes a gift to a trust that the client creates. The client arranges to pay an income stream to the charity for a while. Might be a term of years, might be the client's life expectancy. And after that while is over, whatever is left in the charitable lead trust, either comes back to the client if the client's looking for an income tax deduction, that's the way it's structured, or it goes to the client's family. And if the family, if they're trying to accomplish some estate planning objectives, then that's the structure. But that's the deal. If I'm paying a charity, if I make a gift of $1 million, for example, to a charitable lead trust, and I'm going to pay the charity 5% interest for the next 20 years, right? So I'm making a gift of $1 million. I'm paying the charity in the aggregate $1 million, but it's over 20 years. Well, my charitable deduction's based on the present value of that income stream I'm paying the charity. So while my charitable deduction won't be $1 million, it's going to be close to it in an environment where the present value interest rate's less than half a percent. So I get a big tax deduction, and if the charitable lead trust can outperform that 0.5% interest rate, whatever's left at the end goes to my family, or comes back to me, whichever I prefer in terms of my design. And so it's a way, again, to use interest arbitrage to achieve either income tax planning objectives or family wealth transfer objectives. And it's a terrific thing. People aren't necessarily talking about this, and so as you're trying to raise prospects among high net worth individuals, it's worth visiting with them and their advisors about.
A quick technique around that, and in the essence of time, we won't get into right now, but utilize the income tax savings in year one to keep a policy going to coincide with the duration of the lead trust, right? So it's a 15-year term. You fund year one to carry the policy 15 years. The remainder, it could now be used as a catch-up mechanism in year 16 to pick up the policy where your single premium left off. And here you've now not just replaced the asset, but you've leveraged it, took a significant income tax deduction, and created wealth as a multiple for the next generation. Moving on, and this is a fun one, Lennis, and this is what I was alluding to when I set up this specific topic. You talk about the qualified charitable distribution.
Yeah, we've talked about really sophisticated ideas, Anthony, and we've talked about simple ideas. This falls in the realm of a more simple idea, but I think it's really overlooked. I think this idea is underused. So if you've got a client who is older than 70 and a half and who has an IRA balance, they have the ability to do the qualified charitable distribution, which is something that's been around really for almost 15 years. But as I said, it's underused. How do you do this? Well, you send money directly from the IRA to a charitable organization. And you can do, if you're older than 70 and a half, you can do up to 100 grand in a year. And it does a couple positive things for you. First of all, whatever you send from your IRA to the qualified charitable organization goes towards satisfying your RMD. And if you send up to 100 grand from your IRA and your RMD is less than that, it will go towards satisfying the RMD for your other IRAs if you've got more than one. So that's the first positive thing it does for you. And the second positive thing it does for your client is that what is sent from the IRA to the charity doesn't hit the client's income tax at all. It's not taxable income. Client doesn't have to itemize in order for that to be true. Whereas other charitable gifts, the client does have to itemize. And with a bigger standard deduction these days, not as many of our clients itemize. And so the qualified charitable distribution, because it's an easy thing to do paperwork-wise, ask the plan custodian to send money to the charity. Up to 100 grand can be done if you're 70 and a half or older. The charity gets the money, goes towards satisfying RMD, and you don't have to itemize to exclude the money from income. It's really a no-brainer. And our clients, almost 100% of them, give money to some organization. They give money to some 501c3, whether it's their church, their temple, some organization they care about. They give money away. If they're older than 70 and a half and they have an IRA, or they're interested in rolling money over into an IRA, this technique's a no-brainer. If they're not already using it, they're leaving money on the table. And if you help somebody in that category find money, well, perhaps you can also help them find ways to maximize how to use that money to leverage it through life insurance or some other financial tool to help make sure their family is taken care of if something happens to them. So QCDs are, as I said, IRA only program. We get a lot of questions about, well, can I do it from a 403B or a 401k plan? The answer is no. Money's got to be in an IRA and the person's got to be 70 and a half or older. And the client's got to ask the custodian to send the money directly to the charity. But if all those boxes are ticked, then we're in good shape. So let's pivot and go to the last idea before we kind of wrap this up.
Yeah.
Speaking,
So Linus,
go ahead, Anthony.
I'll tee this up for you. Yeah, I'll tee this up for you. So this is a really popular topic on October 15th of an election year, and there seems to be a lot of water cooler talk about the Trump plan moving forward, the Biden plan moving forward. It seems to be a political football in Congress. Give us a peek into the window of income tax management at death. What is the estate tax landscape look like as we push into not just 2021, but the potential sunset of the current law of 2026?
Sure. Well, first of all, estate tax management isn't as important these days as it has been in the past. Now, I'm not saying for high wealth clients that it isn't an issue, but it's less of an issue under the current law because we've got nearly an $11.6 million federal estate tax exemption. For a married couple, that works out to over $23 million. That's a fair amount of wealth that doesn't get hit with estate taxes. And so for those clients that we might have once had an estate tax conversation with, my suggestion is that it's certainly reasonable to pivot and talk about income taxes. Now, having said that, in line with what you mentioned, Anthony, the increased federal estate tax exemption is in place through 2025. It is set to sunset in 2026. It feels, I don't want to be political, but it feels like it is possible, if not likely, that there will be a change in control in the executive and or one or both, or at least one house of Congress. And so in light of all that, does it seem like going forward that income tax rates and estate tax rates are going to be as low as they are today, right? And with deficit, deficit having dramatically increased due to COVID-19 relief, right? It feels likely the taxes are going to go up, exemption amounts are going to go down. And if we're looking at, a Biden presidency and perhaps Democratic control of the Senate as well, it could happen sooner rather than later. So thinking about taxes is going to be on the minds of a lot of our high net worth clients. And we don't have to talk to them about estate taxes today. We can talk to them about income tax management today. That's the thing that we're sure about. And the thing that's happened in the law is that stretch was shortened. Right? If a non-spouse inherits a qualified account, these days, used to be that they could stretch based on their life expectancy and spread out the income tax result based on life expectancy. Well, now for most non-spouse beneficiaries, that stretch is limited to 10 years. And so that means the income tax result has to be dealt with sooner. And so talking to those folks about that possibility, this is timely because the Secure Act was passed and it was made effective earlier this year. It's timely, and talking to people about the limited stretch and the income tax result is reasonable. And I think asking folks to consider buying life insurance to cover the income tax liability makes perfect sense. And using life insurance to pay income tax liability has some advantages over the typical estate tax management sale because the policy can be owned personally. We're using life insurance to pay for income taxes rather than estate taxes. Well, the death benefit's income tax free even on a personally owned policy. And if we've bought a policy that's got chronic illness or terminal illness features, we don't have to worry about those types of nuances. With an irrevocable trust-owned policy, we can allow the insured or tell the story to the insured that they've got direct access to cash value and lifetime benefits if the policy is being used to help manage income tax results at death. And if you make the sale today to manage income taxes, if the estate tax rules change tomorrow, the client's got insurance in place to consider helping to manage those expenses if the rules change in a way that doesn't benefit the client, right? If the client all of a sudden has estate tax issues in the future, the client's going to be glad that she or he have life insurance in place that can be used to pivot to manage the estate tax issues. So, that's my perspective on what's going on income and estate tax wise. Anthony? All right.
So
Well, go ahead.
Yeah, as we approach 1 o'clock, let me I'll say just a couple parting thoughts, and then turn it over to Linus to Linus to close out. As we live in an environment with an $11.58 million exemption, halfway to 3/4 way through a global pandemic, I think estate planning has been shelved for all intent and purposes. But as you can see today, there is still a lot of work to do. And as society becomes a little more mobile, right? If you walk our main street here in downtown Hamilton, New Jersey, you see life again. You see people, you see businesses open. I was in Central Jersey today. The office building was buzzing. You see society moving around. This is the time where their clients are actively at work and back to their normal lives, yet they still have downtime and they still have a captive audience who's very concerned about their health, their goals, their needs, their wants, and their desires. And they have just come off a grueling 7 months, whether it be in business or facing their own health crisis, where you have their attention. So utilizing any one of these 6 techniques to open dialogue gets you to a place where you'll be in a position to service your clients and potentially sell life insurance. So before I turn it over to Linus to close up, I would encourage you to bring a case study or your questions to your marketing team here at Life Brokerage. This presentation will be recorded. I'll also PDF the slides and send them out to everyone in attendance. If you would like to schedule a follow-up call or case consultation, please feel free to do that. I'm going to turn this over to Linus. We can connect you with Linus if the situation warrants it and you need expertise through our relationship, again, with North American. So fire away your questions. I've been answering a bunch of them on the fly here as you type them into the toolbar. If you have any follow-up questions and would like to take this up one-to-one, just simply reply to the recording and the follow-up PDF. I have a little punch list I'll send you a sample insurance summary review with contingent beneficiary errors, a sample gifting, a state tax calculation that we typically use, a split dollar example, a mirror loan example, the charitable lead trust example, an IRA max example, and a link to Linus's YouTube page, which I think you'll find extremely helpful. So from the folks at Life Brokerage, I thank you for your attendance. I'm going to turn this over back to Linus for our closing comments.
Thank you for that, Anthony. Nicely summarized, and we're available to you through your relationship with Life Brokerage and their relationship with North American. Let us know how we can help you, and I thank you for letting me be part of your presentation today.
Thank you very much. Have a great close to the week and a wonderful weekend.